Today, I'm going to be showing my entire dividend stock portfolio in 2023. It's about that time of the year where I do these type of videos. And look, on this channel, I believe in transparency. I'm literally showing my entire portfolio today. So it would mean a lot if you appreciate the transparency, if you could subscribe. And look, guys, I understand that you want me to make fun of Jeremy, but I can't risk getting a defamation lawsuit and joining him in prison. So for now, I'll just stay quiet. So today, I'll be going over every single one of my positions and my investment thesis on them. Smash the like button, subscribe, and of course, roll the intro.
Hello, I like money.
Currently, at the recording of this video, my portfolio is worth roughly $18,000, $18,171 to be exact, and that has been fluctuating over the last couple of weeks from, around 18,000, high 17,000s up to like 18,300, 18,400, and I'm continuing to add money in every week. These stocks aren't in any particular order either, that I'd mention that before I get into the first holding, but I will mention which ones are core positions and which aren't. And with that out of the way, let's get into the first stock. The first stock, of course, is Apple. Apple, of course, is one of my core positions. If you don't know, now you know. It is a current P/E ratio of 29. And for Apple, I think that's fair, if I'm being honest. They're a very high quality company. And if you really understand their business and the Apple ecosystem, the moat they obtain, I think that's a fair price. But unfortunately, the dividend growth for Apple has not been so nice. They recently, last week, announced a 4.3% dividend hike. Look, in my opinion, I'm obviously a dividend growth investor, so I would love to see like a 10 or 15% increase from Apple. But obviously, they're using that money that they could be doing with a dividend hike. They're using it elsewhere. They're doing, capital expenditures, internal research on new business segments in the future. So I'm not complaining, and I think long term they're going to grow the dividend at a really generous rate. Talking from like a free cash flow standpoint as well, Apple's really as strong as you can get. Their payout ratio is 15.62%, which of course is just amazing. And long term, of course, I'm hoping to see a really good dividend CAGR. 5-year dividend CAGR of 7.87% and a 10-year dividend CAGR of 12.48%. So, they also do share buybacks as well, so, long term, I am going to be getting a nice reward on my investment for Apple. As terms of quality, on the scale of 1 to 10 that I have, I gave it a 10 for sure. One of the highest quality companies in the world, of course. And, the deeper you research into Apple and really how their business works, I think you get a stronger appreciation for them as a company. Currently in my portfolio, I'm not adding Apple at the moment. I'm just letting my small dividends that I get reinvest in themselves right now. But if Apple hits, 150, 140, 130 again, I'm definitely looking to buy. I already have a sizable amount of Apple right now in my portfolio, so, and I don't have a lot of cash to spend in the first place. So, I got to be kind of resourceful with my money and, put it where I think it's put best. And Apple's, it's obviously at pretty high P right now, so got to be a little patient there. Apple's strongest asset I think that they have is their moat, really. And, people just naturally kind of instinctively choose iPhone over any other products. That's how superior they really are. It's so much more convenient. I have AirPods myself. I don't know where I'd be without them, if I'm being honest. There's definitely a ripple effect with the products, too, when somebody buys them. For example, my family, personally, I was the first one in my family to really get AirPods, iPad, iPhone, and all that. So all my family members are now, kind of joining the Apple ecosystem. And, just seeing that from firsthand experience really just gets you, more excited about companies that you invest in. But as for now with Apple, I'm holding on. Hits 150, I will definitely look back to buy back in. I might even dollar cost average once I get access to fractional shares. Next, we have another one of my top holdings, which is AbbVie, stock ticker ABBV. AbbVie is currently trading at a forward P ratio of 13.5. It's obviously kind of discounted because of the Humira patent that they lost this year. And they've always been kind of discounted because, that year, 2023, they're going to lose, their exclusivity to Humira. They're seeing a little bit of losses right now, but they're also seeing build up in other business segments that are making up for that lost cash and lost revenue. AbbVie is an awesome dividend growth stock. Currently, they have a really juicy yield as well, 4.01% yield, and their last dividend hike was 5%. But the 5-year and 10-year dividend growth rates for AbbVie is insane and only makes me want to buy more. Like, look, 5-year CAGR of 14.53% and a 10-year CAGR of 30.61%. That's just nuts. Now, obviously, their dividend growth probably isn't going to be as, as rapid as that, but obviously, I'm definitely expecting, 10% hikes in the next, 10% growth rate, I mean, in the next future, couple of years. All that, and they still have a 44.16% payout ratio, so obviously, still some room to grow that dividend as well, so that's why I'm so bullish on AbbVie. It's hard to find a company that's grown like that in the past and has a great dividend yield and a sustainable payout ratio as well. Obviously, very special to AbbVie there. I actually I'm looking to buy AbbVie right now at the current prices. I'm liking 140, 145. I'm definitely going to be looking to add to AbbVie. I already have a pretty sizable position as well, so those juicy dividend payments from AbbVie are only going to keep on growing. And for asset quality that I gave AbbVie, I give it an 8 out of 10. I'm trying to, 10 out of 10, you got to be a perfect company, but 8 out of 10, that's definitely really good. I personally don't understand healthcare companies like Abby and J&J probably as much as I should, so that's definitely somewhere I want to grow as an investor over the next year, is kind of understanding those businesses more. But with that said, one thing I can understand very well is growth rates, dividend yields, and free cash flow growth, which AbbVie has a lot. For the next stock on this list is the first stock that I ever bought in my portfolio, which is Berkshire Hathaway. Berkshire Hathaway was the first company I ever bought. It was introduced to me initially by my dad, and I kind of just looked over the holdings real quick, and I bought it. Amazing first company to ever buy, obviously. I bought it at $220, and currently it's at 300s. So that's done me well in the past 3 years. Current P ratio of 23. I only have one share, and I haven't bought since my initial purchase, but once I get access to fractional shares in a week or two, I will definitely be looking to dollar cost average back into Berkshire Hathaway and have it really be a core position in my portfolio. Obviously, they don't pay a dividend, but Buffett is still growing my wealth without paying a dividend, so I'm not questioning it whatsoever. As for quality, I gave them a 9 out of 10. They're very high quality company, very diverse. As I mentioned, I think at 23p right now is pretty fair for Berkshire Hathaway. So once I get access to fractional shares, don't be surprised if you see me dollar cost averaging into that. The next stock in my portfolio is another core position that I own, which is Visa, stock ticker V. Currently, Visa is trading at a pretty high P ratio of 27. Obviously, you're going to be paying a premium for that type of quality of company with the moat they have, free cash flow, financials, etc. I think another one of the more appealing things about Visa as well is the high dividend growth rates that they have. The 5-year dividend CAGR of 17.55% and a 10-year dividend CAGR growth rate of 19.62%, and they still only have a payout ratio of 21.09%. That's just nuts in my opinion. And if you look at also, they also do share repurchases, so over time, not only is your dividends growing, but you're also becoming more of an owner in the company with the shares that you bought. I think Visa is the most financially sound company in the world, if I'm being honest. As for quality, I gave them a 10 out of 10. But unfortunately, I like to say the only thing bad about Visa stock is that the valuation's so high. 27p, that's obviously a premium, so, for a company like that, 27p, I'd consider that, fair price, maybe a little overpriced. I currently own 4 shares of Visa at the moment, and don't be surprised if you see me dollar cost averaging into this position as well. I'm a believer of dollar cost averaging and buying into positions during the low times and the high times, but at the same time, you got to be aware of what's too expensive. So with Visa, it's one of my positions. It's not in the top 5 yet. It's probably 6 or 7 in my portfolio. So therefore, I'm probably, once I get access to fractional shares, definitely going to be adding to this position every week or two. With companies that have high dividend growth rates like Visa, Microsoft, Apple, and low yields, it's better just to get into them instead of waiting to buy a dip. I don't see Visa dipping for a long time, so obviously I'm just going to continue to dollar cost average into this position, and over time my dividends are going to compound, and the share buybacks that they're doing are going to benefit me in the long term. Speaking of financially sound, our next stock is not so financially sound at the moment, which is 3M. 3M I bought into a while ago. It was one of those stocks that it was probably the 7th or 8th position that I ever bought in my portfolio, and I can't blame myself looking back at it. Very strong company when I bought in. I bought my first share of Visa ever at $185, and it's just been a nightmare since then. Literally, the worst case scenario for them has occurred, and it's been a rough time as a 3M shareholder. I am down 35% on my position right now. It is one of the highest losing positions, but one of the biggest losers in my portfolio. And I actually owned a sizable amount of 3M too before it fell, so I'm feeling the pain a little bit on this one. Currently, 3M is trading at 11.7p ratio, which is undervalued, but with the risk they have and the risk I'm going to be talking about with them, that is definitely deserved. Obviously, with that lower valuation, the huge sell off it's had, it is trading at a pretty juicy dividend yield, I will admit, at the moment at 5.86%. Unfortunately, the dividend growth on 3M has not been very good recently. Their last dividend hike, which was a few months ago, was 0.7%. 5-year dividend growth rate of 4.09%, and a 10-year dividend growth at 9.52%. Positive, though, regarding the dividend, their payout ratio is 63.38%. That is pretty sustainable in my opinion, and their free cash flow payout ratio is also sustainable. So, during a time like this with 3M, they're declining free cash flows and revenues. Good to see that their payout ratio is still remaining somewhat sustainable. However, with that said, there are some huge risks right now with 3M. Obviously, the biggest risk right now is the thousands of lawsuits that they have pending with other U.S. Former Army members that use the earplugs. Literally thousands of people are filing against them, and the charges and the compensation that they could be owed could go up to $10 billion. So that would probably not look too good for the dividend. So worst case scenario, they do cut the dividend, and but a big popular question, something that I've been asked a few times, is if I think they'll actually cut the dividend. And look, my spin on this, 3M is hiring probably the best lawyers in the world to settle with this. Best thing that could happen, they could resolve this in the next 3 to 5 years. They could get moved past these lawsuits and grow back their business to where it was, prior to all the lawsuits. I do see them settling, probably in the low billions range if I had to guess right now. I don't think the worst case scenario, I'm an optimist, so I don't think the worst case scenario is going to happen, but I do think there is some damage that's going to be done. I think that's the most logical way to approach it. So 3M has the best lawyers in the world probably right now on these cases, and they're going to be doing settlements. They're going to have a lot of settlements to, settle with. And that payout ratio right now, it is still pretty sustainable. If their payout ratio was at like 80 or 90%, or maybe even, 75, if it were a little higher there, I would probably be a little more nervous or more, I would think that they were going to cut the dividend. But right now, I think if they were going to cut the dividend, they would have already done it by now. And the sign that they actually grew their dividend a little bit last dividend hike, it tells me right now that they're not really thinking about that. And obviously, the last dividend hike wasn't some generous hike of 10% or 8%. It's 0.7%. But at the same time, that is still a positive sign if you're an optimist or bull on 3M long term. And as for quality on 3M right now, I gave them a 6.5. Obviously, when I bought in, this probably was a 9 or 8 quality on Spectrum stock. But I think this is just a pure example of you really can't predict what's going to happen in the future, and that no stock is safe. So I gave them a 6.5. They still do. People are just ignoring the fact that they have all these other, businesses that are just cash machines. But at the same time, those risks right now that they have are very real. And I'm just reinvesting my dividends in 3M right now. I do get a pretty sizable dividend for my portfolio at least, that I can reinvest back into 3M and get my cost per share down. And I am a long-term investor, so I'm just holding on right now long-term. I think if I sold right now, it'd probably not be the wisest thing to do. So right now with 3M, I'm just reinvesting my dividends and getting my cost per share down over time. The next stock on this list is one of my favorites, which is Starbucks. Starbucks was one of the first 3 stocks that I ever bought in my portfolio, and it has definitely rewarded me. Currently, Starbucks is trading at a P/E ratio of 31. That is pretty expensive for a coffee stock. I know I mentioned earlier with great high quality companies that I like in my portfolio, I don't really care what the valuation is as long as it's not like 50. But with Starbucks, I will admit here that is overvalued, and I'm not going to be buying at the moment. And, in some of the portfolios that I manage that do have Starbucks, I have actually just recently sold a little bit to take some gains and put it into some lower or some other positions that are maybe down, like SEHD. But personally, for my portfolio and my Starbucks, I'm letting those dividends compound. Currently, they're trading at around a 2% dividend yield. Their last dividend hike was in September, which was 8.2%. Pretty generous there. A 5-year dividend growth rate of 13.15%, and a 10-year dividend growth rate of 18.3%. They have a pretty high payout ratio at 66.24%, or at least high relatively in my portfolio. But their free cash flow to payout ratio is actually much lower, so I'm not fearing there's not much risk to the dividend at all. The fact they got through COVID and didn't cut their dividend also is an amazing thing that tells me as a shareholder that they're committed to it. They also do share buybacks as well, which they recently reinstated. Starbucks was trading a lot in the 70s and 80s about a year ago, and I was buying pretty heavy during then, so that's where I built up a good amount of my position. Obviously, it was also one of the first stocks that I ever bought, but it is really nice to see, when a company is trading lower and there's a risk, there's something involved with it. With Starbucks' case, it was the unions. And, I just knew internally that long term the company would be fine and that this was a really good buying opportunity. And the same thing happened recently with Microsoft as well. And it's really nice to see you get rewarded for believing in a company during the bad times or when others are fearful. Then the stock goes up. It's one of the best feelings as an investor. Starbucks' business model basically allows them to be an interest rate free bank with the reward system. I've made videos on it in the past. Go check them out. As for the type of quality of company that Starbucks is, I gave them an 8.5 out of 10. They say buy stocks that and that's very true for me with Starbucks. I am personally very addicted. I like the I like coffee, so and just seeing, firsthand how reoccurring, Starbucks' customer base and the pricing power that they have make me very bullish on the company long term. As for now, I'm not buying any more Starbucks. I think that valuation is pretty high, but I am reinvesting my dividends. Next on the list, we got Johnson & Johnson. Currently, J&J is trading at a 15.12 P/E ratio. It is down. It is trading near its 52-week low. This is a position that it was probably the 12th or 13th stock that I ever bought. I do think very highly of this company. I think it is a very high quality company. They're currently trading near a 3% dividend yield right now, and their last dividend hike was 5.3%. Their growth rates are moderate, but they are solid. They are very consistent, which is one of the nice things that you like to see with J&J. It's kind of a boring company, but that's what you want ideally as a dividend investor. 5-year dividend growth rate of 6.11% and a 10-year dividend growth rate of 6.36%. As a dividend growth investor, I like to see personally 8-10% long term. But with J&J, the consistency, I think, of the company really makes up for, not the aggressive dividend growth. They also do share buybacks as well. And they have a 44.4% payout ratio, so obviously more room to pay and grow the dividend long term, and it is sustainable. As for quality, I gave J&J an 8. I would say a 9, but there is some legal stuff going on with them right now that does add a little bit of risk. But still, 8, a very strong quality company in my opinion. J&J is actually trading at a pretty appealing price right now, and it is a stock that I do have my watch list and that I could be looking to add to my portfolio very soon. Next on the list, we got McDonald's. McDonald's has just gone up in price ever since I bought it in June of 2020. I bought my first share of McDonald's ever at $192, and right now it is trading nearly at $300. McDonald's is one of the highest quality restaurant companies probably in the world. It is just way too high in valuation right now for me to add to. With that said, McDonald's has basically turned into a growth stock over the last year. They're currently trading at a dividend yield of around 2%. Their last dividend hike was nice and juicy at 10%. 5-year dividend growth rate of 8.26% and a 10-year dividend growth rate of 7.03% and a payout ratio of 55%. So very sustainable dividend there for McDonald's and a very good growing dividend. I don't know what else you guys want me to say about McDonald's. It is just such a high quality company. I gave them a 9 out of 10. Very strong company. As for McDonald's, looking to add to my portfolio, I have 3 shares, so roughly $900 of the McDonald's right now. With that said, when I do get access to fractional shares in roughly a week, I will definitely be looking to add to my McDonald's, and I won't be buying a whole lot, but this could be a position that I could be dollar cost averaging into in the near future. Next on the list, we got the Coca-Cola Company. Coca-Cola right now is currently trading at a P ratio of 24.3, a dividend yield of 2.9%. Their last dividend hike was 4.6%. They've had some pretty slow dividend growth with a 5-year CAGR of 3.48% and a 10-year CAGR of 5.47%. Coca-Cola, kind of like J&J, they're a slow, boring company, but that's what I like. Unfortunately, with these slow, boring companies, they've all ramped up in valuation. And in my opinion, the fact that Coke is trading near PE levels of like growth companies like Apple and Microsoft and Visa, that's just vile. Coke is a boring, slow, and mature company with which I love, but at the same time, I'm not going to be paying a 25 PE for that. And their payout ratio is on the higher side right now. It's nearly 70%. So obviously with Coke right now, I am not buying. But at the same time, long term, I would like to buy if the stock could go down a little bit. Maybe near the 15 to 20 P range, I would look to buy back in. And I gave Coke an 8 out of 10 on the quality spectrum. If the dividend growth was higher and maybe the financials were a little better, they'd definitely be a 9. But speaking of being a little better, I would say that Pepsi is definitely a little better than Coke. Pepsi, which is just like Coke, trading at an egregious valuation of nearly 27. Pepsi has really solid dividend growth rates that are just better than Coca-Cola in general, which is why I would like to add to this stock a little more too, but at the same time, it is just so expensive. Pepsi's brands, in my opinion, really make them stand out from Coke. They have, they have the Frito-Lay brands, they have the food products, and they have the beverage products. Along with that, I think their free cash flow, dividends, and, financials are a little better than Coca-Cola's, so I gave them a 9 out of 10 on the quality spectrum. I would definitely like to buy, but not at a 27 PE ratio. Long term, I obviously would like to have Pepsi as a core position in my portfolio, with that said. Next in my portfolio, we have a company that's been in the news this week, which is Target. Target, I bought pretty heavy during last year, about a year ago when they dropped like 25%. In my opinion, with Target, I think they've been dealing with a bunch of systematic stuff that obviously they can't control and it's out of their hands. So I think they're a very strong company. I like their CEO, Brian Cornell. They're currently trading at a P ratio of 18.58. So right now, I'd say that's roughly fair value for Target. I think Target's another one of those companies where you actually have to go out into the real world and go to a Target on a Friday night or something and just really see how packed it is. They've also had some ridiculous dividend growth in the last few years because they did so well during COVID. I don't think the dividend growth will be as aggressive, so like not 30 or 40%, but I think it still could be generous. They are set to hike their dividend in the coming weeks, so I will definitely be paying attention to that. And as for Target, I give them an 8 out of 10 on the quality scale. I think over the long term, they are going to be very successful, and I am looking to add to my Target position right now. The next company in the list is one that's known by literally everybody in the world, which is Nike. Nike's currently trading at a really expensive, nearly 37 PE ratio. They have a dividend yield, a pretty small dividend, but one that grows pretty aggressively, 1.1%. Nike is a stock that I bought in 2021, and I bought really expensive. I did not understand anything about valuations at this time, and I bought it at $145. And for context, it's trading at like 120 right now, with that's 37 PE still. Absolutely nuts. With that said, I think Nike has one of the strongest brands and strongest moats in the world, and long term, I'm sure they'll do fine. With that said, with my Nike position, I only own one share right now, so I'm not reinvesting massive dividends, but they do have some really solid dividend growth and financials. At the same time, this is a company that I would like to add up in my portfolio. So anything really below a 30 PE, I'll be slowly dollar cost averaging into. And if it gets back to the $90 range and maybe close to the hundreds, I will definitely look to add to my Nike position. Speaking of a position that I want to add to, this next stock is definitely a position that I'm looking to add to over the next year, which is Kroger, stock ticker KR. Kroger is currently trading at 11p ratio, and they have crazy dividend growth. Just look at their 5-year CAGR, 14.87% and a 14.09%. They've done crazy dividend growth in the last few years, and they're still growing it till today. They have a pretty sustainable payout ratio, too, at 23.46. So obviously so much more room to grow the dividend in the future, which is what I want to add now. Kroger is also a very financially strong company. Just like Visa, they do share buybacks, strong free cash flow, The thing that I don't love about Kroger is how the profit margins. This isn't their fault either way. Their profit margins are not very strong, obviously because they're a grocery company. They own so many brands though across the world, and their Albertsons deal, if that goes through, that'll be huge for them. I think Kroger is definitely a position. It is fair value right now, and I'm looking to add to it in my portfolio as we speak. Kroger with AI and automation is bound to do really well in the next 10 to 20 years with it. And as a shareholder, I'm really excited for that. Kroger gets a 9 from me as the type of quality company it is. It's so financially sound. Go look at its financials right now. Come back to the video then. Next on the list, we got Southern Company. Southern Company, I bought a while ago and I really haven't added to since. Pretty strong utility. It's a boring company. They don't have any crazy dividend growth, but a slow, boring company. I like that in my portfolio. So it is a strong company, so I gave it a 7 out of 10. But as for my utilities, this next utility is more prime to what I like, which is a strong dividend grower, which is NextEra Energy. NextEra Energy, they have strong dividend growth, 11.43% 5-year growth rate, and the dividend that they have been growing recently. It is a little expensive right now, but utilities are overall being priced a little higher right now in this market. For NextEra Energy and Southern Company, I'm just holding on to them right now. I don't have a whole lot of cash, but if I did, I would be dollar cost averaging into them both. The next company on this list, I made a video about literally last week, which you should go check out if you haven't already, but which is Disney. Disney right now is in a really awkward position as a company. They're dealing with a whole lot of stuff that I do cover in the video. As for the quality of company right now with Disney, with all the stuff that they've had going on, and financials are not looking too strong post COVID, I gave them a 6 out of 10. I bought the stock right when the pandemic hit, and it has not been a fun road. It's been a roller coaster. But long term, I think Disney will be fine. They do have some challenges right now, I will admit that firsthand. Disney, I'm down on that position a lot too. I bought really expensively. But 22.68 PE, I think if the stock hits the 90s again, I will definitely look to add to my position. With that said, I think the fact that they're bringing back their dividends sometime this year is a really good case for me to hold the stock as well. Next in the portfolio, we have a company that it was one of the first stocks that I ever bought, but I haven't added to since, which is quite literally the trash company Waste Management. Waste Management is one of the most recession-proof stocks in my portfolio, but unfortunately, it is trading at a bit of a high PE ratio for me to add to in good conscience. It's a very high-quality company, so I gave it a 9 out of 10. And, unfortunately, it's so highly priced that, as I mentioned, in good conscience, I can't add to it. But you could see me dollar cost averaging into it eventually to try to build it up in my portfolio and buying on dips. Next in the portfolio, we have the highest weighted position, and I own nearly $2,000 worth of it right now, which is Microsoft. Microsoft obviously may have a micro dividend, but that dividend has been growing with insane growth rates and consistent growth rates, more importantly, and they have a sustainable payout ratio of 28.45%. Microsoft, I think, is the highest quality company in the world right now. Financially, they're as strong as a company can get, and they have monopolistic features. They have very diversified business segments, and in my opinion, they could be the Netflix of gaming. I still am bullish that the acquisition of Activision Blizzard will go through. Even though the UK is trying to block it, I do believe that long term this deal will go through, and that the UK blocking it will be a little road bump. I bought Microsoft heavy when it was in the 230s and even near 225, and capital appreciation has been so great to me with this stock. I do own a lot of it, but of course I do like to own a lot of these high quality positions, but a 32 PE ratio for a company like Microsoft, I have to even say that's a little overpriced. But anything 30 PE and under, I will be looking to add to Microsoft, but dollar cost averaging slowly into it. I already do own a lot of it, so I'm not going to be, super crazy to buy any. Next, we have one of the weaker companies in my portfolio, which is Walgreens. I am kind of looking to sell out of this stock, but I do think that it is underpriced relative to what it should be priced at. Currently, it's trading around $32, $33. I think if it hits 40 or up, I probably will be selling. It's an okay company, but in my portfolio, I want good or great companies, so that's not going to cut it. That's one of the investing mistakes that I think I made really early on, was thinking that I needed to own a lot of stocks and own a lot of okay/good companies, but now I want to consolidate 10, 20 positions and just have it be great companies. So, it's not a horrible company whatsoever, but I would like to see more out of it if they want to continue to be in my portfolio. So this company hits $40, you probably will be seeing me sell out of it. I don't own a lot of it though. I don't own a lot of it though, thankfully. So yeah, I give it a 5 out of 10. Next, we have a company that definitely does want to remain in my portfolio, which is Altria. Altria is obviously known for their crazy dividend yield, but it is also nice to see some moderate and decent dividend growth with that yield as well. Altria, there is some risk to owning it, which I will admit, but it is still very underpriced, and I think the risk is priced into the stock already. Right now in my portfolio, I think I own like the perfect amount of Altria. I don't own like only 3 shares, but I don't have it as big as a position where it's a core position in my portfolio. Because with the core positions of my portfolio, I don't want there to be as much risk as there is with Altria. But at the same time, I don't think people are going to, they have a very addictive product, good pricing power, and strong financials as a company. And they do reward shareholders with share buybacks and good dividends. Right now, I do think Altria is at a fair price and a good price to buy, but I already own enough in my portfolio where I'm not looking to particularly add to. But with that said, I am still reinvesting my dividends, and the snowball effect from that is already showing in my portfolio. As for quality, I gave Altria a 7.5. I think they are a pretty strong business regardless of the industry that they're in. Next, we have one of the smaller positions in my portfolio, which is Corning GLW. They make glass products for like cars, they work with Apple. It's a really interesting business, but at the same time, I do think it is one of those companies that's okay/good. And in my portfolio, I only want great. But they actually do have some pretty solid dividend growth rates, which is one of the reasons that I haven't sold out of the stock. I only own roughly $130 worth of it, though, at the same time, so that compounding will not be huge. They're definitely a solid company, though, at the same time, so that's one of the reasons that I haven't sold out yet. I do have a very small position that I haven't added at the same time, and I do see better opportunities, so I'm just holding on to Corning for now. Next, we have a position that I've recently bought into, which is the railroad giant Union Pacific. This has quickly become one of the most popular dividend stocks in the dividend investing community over the last year or two. Union Pacific is such a strong company financially. They have monopolistic features as many railway companies do have. This is a position that I definitely do want to build up in the next year and a half and eventually make it one of those core top 10 positions in portfolio weight in my portfolio. Along with that, some people are even saying that Union Pacific hasn't even reached its full potential when it comes to management and business execution, which makes me even more excited as a shareholder because of how strong they've been over the last 10 years. Next in the portfolio, we have one of those okay companies that I mentioned earlier, which is Hasbro. Hasbro was one of the earlier stocks that I bought up in my portfolio, and it's been a rough ride. I'm down nearly 30% on the position. I own roughly $190 worth of Hasbro. Bought in the 90s and 100s, but now it's currently trading at like $50 or $60. Definitely been a bumpy road, and I'm going to wait until this one, eventually climbs back up in price. They've had lackluster dividend growth over the last couple of years. I gave it a 4.5 out of 10. Definitely been a rough, bumpy road, and I will be looking to sell this. Next, we have another company that's been in the news recently, which has been UPS. UPS is one of my favorite industrial stocks that I own. Unfortunately, I only own like 2 shares of it, but UPS has rewarded shareholders over the last couple of years with juicy dividend increases and share buybacks. This is a company that I'm actually looking to add to right now, and I do think it is a bit undervalued as they've had a recent dip. I'm looking to buy this stock on the 150s and 160s, and definitely don't be surprised if you see me add to it soon. Moving on to my real estate companies, we have Vici here. Vici obviously is well known by Joseph Carlson viewers, but it is a company that I bought into roughly a year and a half ago. Vici is a very strong company. When it comes to dividend growth and you're looking at REITs, I think it's one of the top dividend growth REITs to own. This is a company that I'm going to look to build up this summer as one of the core positions in my portfolio. Moving on, we have the famous dividend REIT, which is a core position in my portfolio right now, Realty Income. I own roughly $900 worth of O right now. I think Realty Income, where Realty Income kind of has the edge over Vici, is the diversification in tenants, and I think they have stronger tenants that Vici has, but Vici has better dividend growth than Realty Income. I'd pretty much call them the same company, but I gave Vici a better grade with an 8.5 simply because of the dividend growth, and I think the quality of properties that Vici owns compared to Realty Income. Realty Income still has strong properties, but I gave Vici the edge over Realty Income. When it comes to my ETFs in my portfolio, of course I own SCHD, which is the only ETF/index fund that I own, and I own roughly $1,800 worth of SCHD at the moment. And I know I talked about a trash company earlier in waste management. Another trash company that I have is Tattooed Chef, which I actually sold out of literally this week. So wait for the portfolio update to hear more about that. And ladies and gentlemen, that is my entire portfolio as of 2023 May. My goal with that portfolio over the next coming years is to eventually consolidate to only hold good and great companies in my portfolio that have a good economic moat, strong business fundamentals, pricing power, financials, etc. For my time horizon, I am a very long-term focused investor, so my portfolio is going to be shifted more towards dividend growth over the coming years, but of course I still do love my yield. With that said, if you made it to all the way to the end of the video, I can't put into words how much it really means to me. It really helps out my channel and, promotes the video even more. And all I gotta say is that we got a big summer coming for this channel. Thank you for watching, and of course, do dividend stocks, not drugs. Have a good one.